This is a session of a free price action course about candlesticks. If you want to learn most important candlestick that has never been said by other tutor, this course will become handy for you. But first let me thank you for your fantastic energy and support by liking our videos, and please feel free to ask as many questions as you wish about our sessions in comments, and for sure we will try to solve and respond to them. In addition, for show of our gratitude to your support, we will try to provide a flawless free course, which you will not need to spend $1 for learning anymore. Greetings everybody. Smart Money Atlas is in the house. Certainly, you have heard of candlestick patterns in internet, books, and almost every social media that talk about trading. In this session of our free price action course, we will not talk about all of these patterns all over again. But here, we will tell you the best patterns there are and will certainly change your attitude about them. First of all, let's check our knowledge about candlestick and see what it is. As shown in the diagram, the candle is divided into the following three parts. Upper shadow. The upper wick or shadow indicates the high trading session. Real body. The real body gauges the opening and closing price. The lower shadow. The lower wick or shadow depicts the low trading session. A candle has 4 different data points. Open. Open is the price at which the asset trades at the very beginning of the given period, here, as shown by O letter. High is the top of the upper shadow or wick, represents the high price point of an asset, here, as shown by H letter. Low, similarly, is the bottom of the lower shadow, reflects the low price point of an asset, here, as shown by L letter. Close is the closing price at which the last trade has made at the end of the intraday or the given period, here is shown by C letter. As you know, in green candles, we have an open point. Then price increases to highest point. After that, price decreases to lowest point. Finally, price closed in close point. In green candle, closing point is upper than opening point. In red candles, we have price decreases to L. After that, increases to H. And finally gets closed in C. However, remember here, closing point is lower than opening point. If you search the internet, you will find all sorts of candlestick patterns with some odd names, but frankly, we do not like to get messy with these names, as we would like to talk as clear as it is possible. Although knowing these patterns will not guarantee success for you, but certainly will improve your trading decisions and will also help you to recognize that almost all of these candlestick patterns are the same. As a matter of fact, only 4 of them only have importance in trading, and these patterns works as signal to us that shows that if there is continuation for the trend or there is a reversal point, and for this matter, as mentioned before, knowing their name will not solve the main issue. As you may know this channel as a truth-telling one, we should warn you that there is not any pattern that always work, and that is the hard truth. The first pattern that we are going to discuss is Doji. This candlestick appears as a cross in chart as shown. Doji candle mostly indicates that market is confused and direction of trend is lost, and traders in the market cannot decide which way they are heading. In these situations, Doji candle appears and signals the change of previous trend in market. Look at this example. There is clear bearish trend undergoing in the market, and after appearing Doji candle in chart, a trend reversal occurs. There is another example. A bullish trend after appearing a Doji candle changes its course and heads downtown. Sometimes Doji candles appear as a couple or maybe more of them, like 3 or 4 repeatedly, and that shows more confusion in market. But as discussed before, in previous sessions, there is not a certain and clear signal in the market that you can rely on, and likewise after seeing a Doji candle, you should not jump to conclusion that there is reversal happening in trend, and you should check the other parameters as well, like support and resistance zones, that we talked before. Let's talk about next one that almost looks like a Doji bar and kind of looks like a hammer, and guess what they call it? Yep, correct, they call it hammer. As discussed before, we are not here to memorize candlestick patterns name, so we call all of them a pin bar. If you just simply search the internet, you will find all kinds of hilarious names for these patterns that, besides filling our head, will not do any good. These candles as shown here are pin bar, and it does not make any difference if they appear in bearish or bullish trend, we will call them a pin bar candle. Visual characteristics of a pin bar are a small body with a long tail from either side of it. Notice that in any of these shapes presented here, the body of candle is not in the middle of it, and if so, it will be called a Doji bar, not a pin bar. A pin bar must have long tail or shadow in trading terms, form one side of it, and should lean toward one side. We call all of these shapes a pin bar. Now let's get to the point that why pin bar appears. Assume market has a bullish trend and price is increasing. This trend proceeds to a certain resistance zone. If you have hard time recognizing support and resistance zones, we strongly advise you to watch our very important session about these zones in our channel. When price reaches this zone, there is strong possibility that a trend reversal happens. Price aggressively moves towards this resistance zone, but gets rejected and cannot break the zone. In this price, a lot of sellers are waiting patiently to enter the market, and as price reaches it, a pin bar is born. It is same story in bearish trend. Now it is clear to us that a pin bar is signal of change in trend, and we do not need to remember all kind of names to understand this matter. So by their nature, doji bar and pin bar actually are similar and that do the same job. As a result, when we search for them in chart, there is no need to look at them separately. Let's enjoy some beautiful doji bars and pin bars and in real chart, so your mind comes familiar with this concept, and increase your speed of recognizing them. In this example, we are going to look at chart step by step and talk about available doji bars and pin bars. First of all, look at this chart and try to understand the movements that price did. Here, couple of doji bars indicating confusion in market, but as a follow-up candle, a bearish one rejects any upward momentum. Again, 3 doji bars and a following strong bearish candle shows buyers are losing hope and new sellers are entering the market. Here, a strong pin bar and expecting a bullish trend to begin. But next candle is a weak bearish one and again disappoints bulls in the market, and bearish trend accelerates with new blood of sellers. Couple of dojis appears after a bearish spike but has set a strong momentum rules in market. Isn't market beautiful? It speaks clearly, only a good listener is needed. Let's continue. Here, a couple of doji bars after a big bearish candle that shows exhaustion in trend. This signals a pullback. Early sellers are cashing out. And after 2 candles, buyers are gaining momentum. After a pullback, a pin bar appears that shows bulls' weakness in controlling momentum and maybe bearish trend will continue. Here, clearly bulls lost momentum and couldn't break last lower high. So after forming these 2 doji bars, a lot of buyers are losing hope and later bears are taking advantage of this point and are entering the market. Do we open a long position after seeing this doji bar? The correct answer is we wait and see next candle. It is clearly a big bearish one. So in contrary, we open a short position and we put the stop loss point behind pullback's high. Market continues to its main bearish trend and tries to break its previous low. After second rejection of breaking the low, 2 pin bars indicates probability of trend reversal. But again, we wait to see the follow-up candle. A massive bearish candle that is bigger than previous 10 candle pushes price lower. A pin bar after a long bearish run in market that continued more than 50 or 60 bars could signal a trend reversal point. After seeing a big bullish candle, and gives a high possibility that bulls are gaining power and are entering market heavily with their guns. Again, after 5 green candle, by appearing this pin bar, a confusion enters the market. Following candle is again bearish, so it may signals another try of breaking the previous low is on the way. Here, a big pin bar shows for the first time in a while. Sellers are losing hope of controlling the trend. And finally, by forming this doji bar, in the exact point of previous low, rejects the possibility of any new lower low. Next pattern, we call it 3 candle pattern, and you can name it whatever you want in comment section. They appear as shown here. So let's talk about them. As you can see, there is increase in price, and after appearance of a pin bar that signals a probable change of course in trend, a third confirmation candle appears and raises the possibility of change in trend. But how we could obtain these data from 3 candles? For sure, not every candle that appears after a pin bar promises a reversal in trend. Here is an example. We put open, close, high and low of candles on them. Obviously, there is a bullish trend. Assume time frame is daily. In first candle, the price has gone up to H1, then has came to the closing price of C1. In second candle, price has broken the resistance, but has returned in closing price is less than opening one. In final candle, price has dropped and the close price is less than the low point of previous candle. For these reasons, there is high probability that there is going to be a trend reversal and we could open a short position and enjoy the outcome. Contrariwise, it is also true in bearish trends. After formation of a pin bar, we should check if third candle close is higher than previous high, and if so, there is high possibility of bullish trend reversal. Remember, as always, in price action concept, before opening a position, determining the support and resistance zones is crucial. We talked about them in previous session, so watch it carefully and take notes. If you liked this session so far, please do not forget to like and subscribe. The last candlestick pattern is engulfing bar. As shown in diagram in bullish trends, we see a bearish candle but its close is lower than previous candle's low and has a noticeably big body. In other words, sellers are entering the market in big volume and creating a bearish momentum. Obviously, in bearish trend it goes the other way, and a big bullish candle indicates the entering of buyers to market and a bullish momentum is about to happen. Remember, no need to say that, a big engulfing bar is much stronger signal of trend reversal. However, it has the downside of entering late in trade. Here are some examples in market about 3-candle pattern and engulfing bar. Here, we see a 3-candle pattern, but following candle is bearish and it does not show promising upward trend. After a major pullback in bearish trend, and failing to make higher high, a strong engulfing bar forms. A bearish follow-up gives a high possibility of a continuation in bearish trend. Again, here, an engulfing bar appears, but as told earlier, we should wait and see next bar formation. A weak bearish candle does not make good impression and trend fails to reverse. Following a confusion in market, a powerful engulfing bar closes below last 3 candle. Next candle is bearish candle. Therefore, a sell position with high possibility of success is a logical move. We could call this 3-candle pattern the perfect one. A strong 3rd candle in 3-candle pattern is very good signal in trend reversal, and as market continues we can see profitable position happening. Here is another good example of 3-candle pattern. We could open a long position and set stop loss point behind this 3-candle pattern. Finally, another perfect example of 3-candle pattern occurs here. At third attempt of breaking the support formed here, a 3-candle pattern appears and gives a high probability of hitting higher numbers. That is it for candlestick patterns, but let's see what happens if we gather 3 candlestick pattern together. You can see by adding first 2 we have a big bullish candle that price reaches H2 then closes in C2. Then after adding 3rd candle, the result is a pin bar. Again, by adding 2 engulfing bars together, the result is a pin bar. Assumed time frame was 30 minutes. After adding the time frame changes to 1 hour. Therefore, in higher time frame we see a pin bar. To make a long story short, doji bar and pin bar is the main signal in trend reversal, and all the rest of candlestick patterns are derivatives of these two. So by understanding this point you can master the candlestick concept in price action. Please remember, price action is a full concept that has a structure, and for making constant living from trading you should implicate all the parameters together. For better understanding of these factors you can watch our price action volume 1 session. That is it for this session of price action course. If you enjoyed, you know what to do.